Coca Cola, ticker KO, is a well-known recognizable brand and company. It's one of Warren Buffett's best investment. KO is currently trading at the time of this recording at $63.22 per share with a market cap of $276.17 billion. In this video, we will go through the financials of the company, some quick valuation, and a SWOT analysis. Let's dive in. Looking at the income portion, revenue is $43 billion, EBITDA is $13.83 billion, net income is $9.54 billion, EPS is $2.20, and adjusted free cash flow is $9.18 billion. In the parentheses, we have the 10-year performance of the segments. Revenue is down 1.10%. This is not an alarming amount because net income, EPS, and free cash flow are up. This means KO could be spending less money on capital expenditure, doing less stock-based compensation, and overall the company is producing and having cash available. Taking a look at the margins of the company, profit margin is a little under 23%, while operating margins is 28%. For a blue chip company that has been for decades and still be able to provide this type of numbers, I say that this is very good. Coca Cola is a consumer staple and their products are consumed globally. Even in a high inflationary environment, they have the capability to increase their prices so it keeps their margins up. We can see that reflected in their quarterly earnings of 12% and their revenue increase of 5%. All companies carry some sort of debt, either short or long term. On KO's end, they have $13.13 billion cash available while having $36 billion in debt, for a net debt of negative $23.78 billion. The amount in debt has been on a downtrend since 2021. So far, we have increased free cash flow and net income while debt is slowly going down. Looking at the dividend of Coca Cola, we have an annual payout of $1.84. With the current prices, it yields at 2.88%. The payout ratio is sitting at 70% and is on the low high end, so it has room to grow the dividend, but hopefully they are able to reduce this ratio in the future. The 5-year growth of the dividend is 3.48%. This growth is above the average inflation of 2.20%. Coca-Cola has been growing this dividend for 60 years. Moving to the PE ratios, we're comparing KO to the market, industry, its 5-year average, and competitors. So we have Coca-Cola with a 25.32 PE ratio. When we compare it to its 5-year average, which is 24, we can see that at current valuations, Coca-Cola is a bit expensive. Even more expensive than the market that is currently sitting at 18 PE. When we compare it to the consumer staples sector, KO is still looking expensive, but competitors like Pepsi and Monster look more overvalued at current prices. Overall, yes, I will say Coca-Cola is expensive based on PE. Taking a glimpse on the valuations of the company, let's start with the PE growth, the PEG. Coca-Cola PE growth is currently at 2.78. Based on PEG, Coca-Cola is very expensive since the value is above 1. Looking at the ROCE, KO has a 14.94%. When I look at this metric, I prefer it to be at least double the Fed fund rate, which in this case is almost triple. I put the ROCE in the valuation sector just to remind myself that even if a stock is expensive, it could still have relevant return on capital and justify the premium. I also did a quick discounted cash flow for KO. Using the last 10 years free cash flow values, KO has a 4.02% growth rate. Using the perpetual growth of 2.5%, future free cash flow estimate of 4%, and a discounted rate of 6%, we came up with a fair value of $62.25. Assuming that my estimates are 100% correct, we can deduct that KO always has a premium to pay, meaning that it will mostly look expensive when you want to buy it. So if you're looking to enter or DCA on your Coca-Cola holding, you will need to apply a margin of safety to the fair value. To wrap everything up, let's do a SWOT analysis. Sometimes there are some factors that can't be calculated. A SWOT analysis could help you understand a perspective outside of a number-related standpoint. Let's begin with the strengths of Coca-Cola. Strong brand value. Coca-Cola is one of the most recognizable brands in the world. Wide distribution network. Coca-Cola is almost sold in every place you visit. Diversified product portfolio. Beside the well-known drink known as Coca Cola, it also sells soft drinks, juice, water, and energy drinks. Then we have effective marketing campaign and strong financial performance. On the other hand, we have weaknesses. Dependence on carbonated drinks. Most of KO's revenue is from carbonated drinks and they have been in a decline in sales. This put us on the second point, negative health perceptions. The contents of its products has brought some impacts on human health, and this could be related to people opting for healthy choices, therefore a decline in its carbonated drink sales. Coca-Cola has limited presence in health and wellness. It's a market that they might need to explore and capitalize as people are opting for healthy beverages. And last, dependence on external bottlers. Relying on independent bottlers to produce and distribute your product can limit quality and in some cases, distribution. So what opportunities can Coca-Cola explore to maintain its relevance into the future? Well, they can diversify into non-carbonated drinks. They have already bottled water, tea, and juice. They can expand those portfolios by creating new brands. Expanding into emerging markets. Even though Coca-Cola is known worldwide, it is not the leading product in some areas. So capitalizing in growing consumer-based areas could be a catalyst. Investing in sustainability. As we head into a cleaner green world, Coca-Cola can invest in practices such as reducing plastic waste, water consumption, and enabling a more efficient recycling method. And lastly, acquisition and partnerships. If Coca-Cola cannot create a solid brand, then acquiring one could be an option. Acquiring a brand with a strong presence allows diversification of your portfolio and exposure to new consumers. Now, looking at the last part of the SWOT analysis, threats. Coca-Cola faces intense competition from other soft drinks companies. Health concerns. The negative health perception of soft drinks can lead to declining demand and regulatory pressures. Economic volatility. Economic downturns like the pandemic, for example, can dent on the revenue and profits of Coca-Cola. Changing consumer preferences. Consumers are shifting towards healthier alternatives. This can pose a threat to Coca-Cola's core business. Overall, I believe Coca-Cola is a great investment. Like any other business, it has the good and the bad. This company has existed for more than a century and has provided value to shareholders. I personally own Coca-Cola shares. My position keeps getting smaller and smaller week by week as I'm investing in other companies. I have been keeping a close eye so I can buy more, but I have not found the entry yet. I'm looking to buy when it's in the range of $50 to $55 per share. So that will be it for this video. If you like this type of content, please let me know in the comment section below. Thanks for watching and till next time.